Let's be honest, most people hear the word macroeconomics and instantly think it's something complicated, boring, and only meant for experts in suits sitting in government offices. But here's the truth, macroeconomics is already controlling your life, whether you understand it or not. Every time prices go up at the grocery store, every time interest rates change, every time jobs become easier or harder to find, that's macroeconomics in action. You don't need a degree to understand it. But once you do, the world starts making a lot more sense. Suddenly, news headlines stop feeling random, and you begin to see patterns behind everything that's happening around you. So what exactly is macroeconomics? In the simplest terms, macroeconomics is the study of the entire economy, not one person, not one company, not one product, but everything together. It looks at how millions of people, businesses, and governments interact, and how those interactions create trends like inflation, economic growth, unemployment, and interest rates. Think of it like zooming out on a map. Microeconomics is zoomed in, it looks at small details like why a product is expensive or how a business sets prices. But macroeconomics zooms out and asks bigger questions. Why is everything getting more expensive? Why are wages rising or falling? Why is the economy growing or slowing down? And this is exactly why macroeconomics matters, because these big forces shape your daily life more than you realize. Inflation affects how much your money can buy. Interest rates affect your loans, your credit cards, and even your investments. Economic growth affects your job opportunities and income potential. Even if you never think about macroeconomics, it's constantly affecting your decisions. The good news is, once you understand the basics, you gain a huge advantage. You stop reacting emotionally and start thinking logically. Now, to understand macroeconomics, you need to understand one simple but powerful idea. The economy is a system. Everything is connected. Nothing happens in isolation. When one part of the system changes, it affects everything else. Imagine a simple loop. Businesses produce goods and services. To do that, they hire workers and pay wages. Those wages become income for households. Households then spend that income on goods and services. That spending creates demand, which encourages businesses to produce more. And the cycle continues. This is called the circular flow of the economy, and it's the foundation of everything. But here's where it gets interesting. If one part of this loop slows down, the entire system feels it. If businesses reduce production, they hire fewer workers. If fewer people are employed, income drops. When income drops, spending falls. And when spending falls, businesses reduce production even further. This is how slowdowns and recessions begin. It's not one event, it's a chain reaction. And this is why confidence matters so much in an economy. Because when people feel uncertain, they spend less. And when spending drops, everything else follows. Now let's talk about the main players in this system. First, households. That's you, me, and everyone else. Households provide labor, earn income, and decide how much to spend and how much to save. These decisions might seem small individually, but together they drive the entire economy. When people spend more, businesses grow. When people save more and spend less, growth slows down. Second, firms. These are the businesses that produce goods and services. They decide how much to produce, how many employees to hire, and how much to invest in the future. Their decisions depend on demand, costs, and expectations. If they expect strong growth, they expand. If they expect a slowdown, they become cautious. The third major player is the government. Governments collect taxes and spend money on things like infrastructure, healthcare, education, and public services. But their role goes beyond just spending. They influence the economy through policies. When the economy slows down, governments may increase spending or cut taxes to boost demand. When inflation is high, they may reduce spending or increase taxes to cool things down. These decisions are known as fiscal policy, and they play a huge role in shaping economic outcomes. Now let's move to one of the most important and widely discussed concepts in macroeconomics: inflation. Inflation is one of those words everyone hears, but few people fully understand. Most people think inflation simply means prices are high, but that's not exactly correct. Inflation means prices are rising over time, which means money is losing value. If something costs $10 today and $11 next year, that's inflation. And if this keeps happening year after year, your money buys less and less. This brings us to purchasing power. Purchasing power is simply how much your money can buy. When inflation rises, purchasing power falls. Even if your income stays the same, your real wealth is decreasing because everything is getting more expensive. This is why inflation is often called a hidden tax. It slowly reduces the value of your money without you even noticing it day by day. Over time, the impact becomes significant. But here's something important to understand: not all price increases are inflation. If the price of one product rises because of a temporary shortage, that's not true inflation. For example, if oil prices spike for a few months and then fall back, that's a price shock. Inflation is when the overall level of prices continues to rise across the entire economy. This distinction matters because inflation affects long-term decisions, while temporary price changes usually do not. So how do we measure inflation? Economists use something called the Consumer Price Index, or CPI. The CPI tracks the price of a basket of goods and services that a typical household consumes. This includes things like food, housing, transportation, healthcare, and energy. By measuring how the price of this basket changes over time, we get a sense of how inflation is moving. If the basket becomes more expensive, inflation is rising. If prices stabilize, inflation slows down. But here's where things get personal. Official inflation is an average. It represents a typical household, but no household is truly typical. Your personal inflation rate depends on what you spend money on. If you spend a large portion of your income on rent and food, and those prices rise quickly, your personal inflation will feel much higher than the official number. And that's why many people feel like inflation is worse than what the data shows. They're experiencing it differently. Now let's talk about where inflation actually comes from. There are several forces behind it, but one of the most common is demand. When people want to buy more goods and services than the economy can produce, prices rise. This often happens during strong economic growth. People have jobs, incomes are rising, and confidence is high. Businesses respond by increasing prices because demand is strong. Another cause is supply issues. If it becomes harder or more expensive to produce goods due to rising costs, shortages, or disruptions, companies raise prices to maintain profits. There's also the role of money itself. When the money supply grows faster than the economy's ability to produce goods and services, each unit of money becomes less valuable. This can lead to inflation over time. And finally, there's psychology. If people expect prices to rise, they behave differently. Workers demand higher wages. Businesses raise prices in advance. Consumers spend more now instead of later. These behaviors can actually create inflation, making it self-reinforcing. And this is why managing inflation is one of the biggest challenges in macroeconomics, because it's not just about numbers, it's about expectations and behavior. Once inflation becomes part of people's mindset, it becomes much harder to control. Now let's pause here, because this is where most people start to see the bigger picture. Macroeconomics isn't just theory, it's a framework for understanding reality. It explains why money loses value, why economies grow and shrink, and why financial decisions matter more over time. And once you understand these basics, you're no longer just reacting to the economy, you're thinking ahead of it. Now that you understand how inflation works and why the economy behaves like a connected system, it's time to move into one of the most powerful forces in macroeconomics: interest rates and central banks. Because if inflation is the problem, interest rates are one of the main tools used to control it. And once you understand how this works, you'll start to see why markets move the way they do, why loans suddenly become expensive, and why headlines about rate hikes create so much noise. Let's start simple. Interest rates are basically the cost of borrowing money. If you take a loan, the interest rate is what you pay on top of the amount you borrowed. If you save money, the interest rate is what you earn. But in macroeconomics, interest rates are much more than just a number. They are a control mechanism. They influence how much people spend, how much businesses invest, and how fast the economy grows. Now here's the key idea. When interest rates are low, borrowing is cheap. People are more likely to take loans, buy houses, spend money, and invest. Businesses are more willing to expand, hire more workers, and invest in new projects. This increases economic activity. On the other hand, when interest rates are high, borrowing becomes expensive. People spend less, businesses slow down investment, and the economy cools off. So interest rates act like a volume control knob for the economy. Turn it up, and growth slows down. Turn it down, and growth speeds up. But who controls this knob? That's where central banks come in. A central bank is the institution responsible for managing a country's money supply and financial system. In the United States, this is the Federal Reserve. In the United Kingdom, it's the Bank of England. In Europe, it's the European Central Bank. These institutions don't operate like regular banks. You can't walk into a central bank and open a savings account. Instead, they manage the system behind the scenes. The main goal of a central bank is to maintain price stability, which usually means keeping inflation under control. But they also care about economic growth and employment. And to achieve these goals, they use a set of tools known as monetary policy. The most well-known tool is the policy interest rate. This is the rate at which central banks lend money to commercial banks, and it influences all other interest rates in the economy. When inflation is rising too quickly, central banks raise interest rates. This makes borrowing more expensive, reduces spending, and slows down the economy. The goal is to reduce demand so that prices stop rising so fast. On the other hand, when the economy is slowing down or in a recession, central banks lower interest rates. This encourages borrowing, spending, and investment, helping to stimulate growth. But interest rates don't just affect loans and spending, they also affect financial markets. When interest rates are low, investors look for higher returns. They often move money into stocks, real estate, and other riskier assets. This can push asset prices higher. But when interest rates rise, safer investments like bonds become more attractive because they offer better returns with lower risk. As a result, money can flow out of stocks and into bonds, causing stock prices to fall. This is why you often see markets react strongly to central bank announcements. It's not just about the current rate, it's about expectations. If investors expect rates to rise, they adjust their behavior in advance. And that's another key idea in macroeconomics. Expectations shape reality. Markets don't just react to what happens, they react to what they think will happen. Now let's talk about something very important: central bank independence. Central banks are designed to operate independently from political pressure, and there's a good reason for this. Governments often have short-term goals, especially around elections. They may prefer low interest rates and high spending to boost the economy quickly. But these policies can lead to high inflation in the long run. Central banks, on the other hand, are meant to focus on long-term stability. By being independent, they can make decisions that are better for the economy over time, even if those decisions are unpopular in the short term. Now that we understand interest rates and central banks, let's move to another core concept: gross domestic product, or GDP. GDP is one of the most important measures in macroeconomics because it tells us how much economic activity is happening in a country. In simple terms, GDP measures the total value of all goods and services produced within a country over a specific period of time. Think of GDP as the economy's scoreboard. If GDP is increasing, the economy is growing. If GDP is decreasing, the economy is shrinking. But it's important to understand what GDP actually includes. It includes consumption, what people spend, investment, what businesses invest, government spending, and net exports minus imports. These components together give us a picture of how the economy is performing. But there's an important distinction. We need to make nominal GDP versus real GDP. Nominal GDP measures economic output using current prices. So if prices rise due to inflation, nominal GDP can increase even if actual production doesn't change. Real GDP, on the other hand, adjusts for inflation. It measures output using constant prices, which gives a more accurate picture of true economic growth. This is why economists focus more on real GDP when analyzing the economy. Another useful measure is GDP per capita, which is GDP divided by the population. This gives an estimate of economic output per person and is often used as a rough indicator of living standards, but it's not perfect. It doesn't account for income inequality or quality of life. A country can have high GDP per capita but still have large gaps between rich and poor. Now let's move to something that affects everyone: the business cycle. The economy doesn't grow in a straight line. It moves in cycles. These cycles consist of four main phases: expansion, slowdown, recession, and recovery. During expansion, the economy grows. Businesses hire more workers, incomes rise, and spending increases. This is the phase people enjoy the most. Then comes the slowdown. Growth begins to weaken. Businesses become cautious, and consumers may start spending less. If this slowdown continues, it can turn into a recession. A recession is typically defined as a period of declining economic activity, often measured by 2 consecutive quarters of negative GDP growth. During a recession, unemployment rises, spending falls, and confidence drops. This is when the economy feels the most difficult for people. But recessions don't last forever. Eventually, the economy enters a recovery phase. Spending begins to increase again, businesses start hiring, and growth returns. Governments and central banks often play a key role during this phase by lowering interest rates or increasing spending to support the economy. Over time, recovery leads back to expansion, and the cycle continues. Now here's something important to understand: recessions are not always bad. They are a natural part of the economic cycle. They can help correct imbalances, reduce inflation, and reset the system. But severe recessions can cause real damage, especially when unemployment rises sharply or financial systems become unstable. If we look at history, we can see examples of how powerful these cycles can be. The 2008 financial crisis started with problems in the housing market, but quickly spread to banks and the global economy. Lending froze, businesses collapsed, and millions of people lost jobs. More recently, the COVID-19 recession was caused by a completely different factor: lockdowns that stopped economic activity almost overnight. These examples show that recessions can have different causes, but the impact can be widespread. Now let's connect all of this back to your life and investing, because understanding macroeconomics isn't just about theory, it's about making better decisions. When you understand interest rates, you understand why loans become expensive and why housing markets change. When you understand inflation, you understand why your money loses value over time. When you understand business cycles, you understand why markets go up and down. One of the most useful tools for applying macroeconomics is the economic calendar. This is simply a schedule of important economic events like inflation reports, GDP releases, and central bank meetings. These events can move markets because they change expectations. For example, if inflation comes in higher than expected, investors may expect interest rates to rise, which can affect stocks and bonds. But here's the key point: the goal is not to predict the future perfectly. That's almost impossible. The goal is to understand the environment you're operating in. When you understand the bigger picture, you make better decisions, you avoid panic, you stay rational, and over time, that makes a huge difference. Because in the end, macroeconomics is not just about countries and policies, it's about understanding the forces that shape your financial life. And once you understand those forces, you're no longer just reacting to the world, you're thinking ahead of it. Now that you understand inflation, interest rates, central banks, and economic cycles, it's time to zoom out even further, because economies don't exist in isolation. Every country is connected to the rest of the world through trade, currencies, and capital flows. And this global connection is what makes macroeconomics even more powerful and sometimes more unpredictable, because what happens in one country can quickly affect another, and understanding this connection gives you a much deeper perspective on how the world really works. Let's start with exchange rates. An exchange rate is simply the value of one currency compared to another. For example, if $1 equals 0.90 euros, that's the exchange rate between the dollar and the euro. But this number isn't fixed, it changes constantly based on supply and demand, and those changes have real consequences. If your country's currency becomes weaker, imported goods become more expensive. If it becomes stronger, imports become cheaper. But exchange rates don't just affect prices, they affect entire economies. Imagine a country whose currency weakens significantly. Suddenly, its exports become cheaper for foreign buyers. That can boost demand for its products and help businesses grow. At the same time, imports become more expensive, which can reduce demand for foreign goods. On the other hand, if a country's currency becomes too strong, its exports can become expensive, making it harder for businesses to compete globally. So what determines exchange rates? At the core, it's supply and demand. If investors, businesses, and governments want a currency, its value rises. If demand falls, its value drops. But what drives that demand? Several factors. Economic growth is one of them. Countries with strong growth tend to attract more investment, increasing demand for their currency. Interest rates are another major factor. Higher interest rates often attract foreign capital because investors seek better returns. Political stability also matters. Investors prefer stable environments, so uncertainty can push money away from a country, weakening its currency. Now let's talk about different exchange rate systems. Some countries have floating exchange rates, where the currency value is determined by the market. This is the case for major currencies like the US dollar and the euro. Their values move freely based on global conditions. Other countries use fixed or pegged exchange rates. In this system, the government or central bank sets a target value for the currency and actively intervenes to maintain it. This can provide stability, but it requires significant resources and constant management. This brings us to foreign reserves. Foreign reserves are assets held by a country's central bank, usually in foreign currencies, gold, or government bonds. These reserves act as a safety net. They can be used to stabilize the currency, pay international obligations, or respond to financial crises. For example, if a country's currency is falling too quickly, the central bank can use its reserves to buy its own currency and support its value. Now let's move to international trade. One of the most visible aspects of macroeconomics, trade is simply the exchange of goods and services between countries. One country produces something efficiently, another produces something else, and they trade to benefit both sides. This idea is based on comparative advantage, the concept that countries should specialize in what they do best and trade for the rest. To measure trade, we use something called the trade balance. This is the difference between exports and imports. If a country exports more than it imports, it has a trade surplus. If it imports more than it exports, it has a trade deficit. Now here's something important: a trade deficit is not automatically bad, and a trade surplus is not automatically good. It depends on the context. For example, a country with strong economic growth may import more because its consumers and businesses demand more goods. That can create a trade deficit, but it may also reflect a healthy, growing economy. On the other hand, a trade surplus might indicate strong export industries, but it could also mean weak domestic demand. So the numbers alone don't tell the full story. You have to understand the reasons behind them. Now let's talk about capital flows, which is the movement of money between countries. This is where macroeconomics becomes even more dynamic. Capital flows are driven by two main factors: returns and safety. Investors move money to countries where they can earn higher returns, whether through interest rates, business opportunities, or economic growth. At the same time, They also move money to places they consider safe during times of uncertainty. For example, if a country offers higher interest rates than others, it may attract foreign investors looking for better returns. This increases demand for that country's currency and can strengthen it. But if that country becomes politically unstable or faces economic problems, investors may quickly move their money elsewhere. This outflow can weaken the currency and create financial pressure. Now let's connect this to one of the most important topics: government debt and country risk. Governments often borrow money to fund spending, especially during economic downturns. Borrowing itself is not necessarily a problem. In fact, it can be useful, but the key question is whether the debt is sustainable. Debt is sustainable when a country can continue to pay interest and repay its loans without needing to borrow excessively just to survive. This depends on factors like economic growth, tax revenue, and interest rates. If a country's economy is growing faster than its debt, it can manage the situation. But if debt grows faster than the economy, problems can arise. There's also an important difference between domestic debt and foreign debt. Domestic debt is borrowed in the country's own currency, usually from its own citizens or institutions. Foreign debt is borrowed from other countries or in foreign currencies. Foreign debt can be riskier because if the country's currency weakens, it becomes more expensive to repay that debt. Now let's talk about country risk. This is the risk that a country may not be able to meet its financial obligations or may face economic instability. Investors measure this risk through things like credit ratings and risk premiums. A higher risk premium means investors demand higher returns to compensate for the risk, and this affects everything from borrowing costs to currency value. Now let's bring everything together by looking at how macroeconomics connects to your personal financial decisions. Because at this point, you're not just learning concepts, you're building a framework for thinking. When you understand inflation, you realize why holding cash for long periods can reduce your wealth. When you understand interest rates, you understand when borrowing is cheap or expensive. When you understand economic cycles, you understand why markets don't move in straight lines. And when you understand global factors like exchange rates and capital flows, you start to see how interconnected everything really is. One of the most practical tools you can use is the economic calendar. This gives you a schedule of key events like inflation data, GDP releases, and central bank decisions. These events don't just matter to economists, they move markets. They influence expectations, and those expectations drive prices in stocks, bonds, and currencies. But here's the most important idea too. Remember, the goal is not to predict the future perfectly. That's not realistic. Even experts get it wrong. The goal is to understand the environment you're operating in. When you understand the environment, you make better decisions. You avoid emotional reactions. You stay focused on long-term thinking. Because at the end of the day, macroeconomics is not about memorizing terms, it's about understanding patterns. It's about seeing the connections between inflation, interest rates, growth, and behavior. It's about realizing that the economy is not random, it's a system, driven by incentives, expectations, and human decisions. And once you start seeing those patterns, something changes. News headlines stop feeling confusing. Market movements stop feeling unpredictable. You begin to understand not just what is happening, but why it's happening. And that awareness is incredibly valuable. So whether you're investing, saving, or simply trying to make better financial decisions, macroeconomics gives you an edge. It helps you think clearly in a world full of noise. It helps you stay rational when others panic. And over time, that difference in thinking can completely change your financial future.